Is real estate market going to crash? Is investing in real estate now a good time? Are we in a real estate bubble? In which city should I buy a house? If you are asking any of these questions to yourself, then watch this video to the end and you will know the answers. Hi guys, much awaited analysis of German real estate market 2020 is here now. In this video, I will share with you the reports published by Deutsche Bank and PWC on investing in German real estate market and what do I think about the current real estate market situation. I will discuss with you the factors that influence real estate market, how they affect the real estate market, their contribution in the past, and how it may change in future. At the end, I will share with you my opinion on whether one should invest in real estate now or not, and what can we expect in German real estate market once the pandemic is over. So here is the list of factors that we will cover in this video: mortgage interest rate, population growth, new construction, rent, macro-prudential measures by the government, work from home, living area, and finally some history lessons. In the first part, we will discuss two factors that influence real estate market. The first factor that influences real estate market is the mortgage interest rate. It's a common knowledge that low mortgage interest rates makes investing in real estate attractive and is one of the main factors that contributed in real estate boom in Germany the past decade. So the current mortgage interest rates are historically lowest, but important is to know how it will change in future. Mortgage interest rates in general are influenced by three factors: inflation, minimum counter-cyclical capital buffer, and the three key ECB or European Central Bank interest rates. Most of the economists regularly surveyed by the ECB expect inflation to fall somewhere short of the target rate over the next couple of years. As per this report, Deutsche Bank anticipates inflation of just 0.4% and 1.1% in 2020 and 21 respectively. In light of this, Deutsche Bank expects mortgage rates to hover just above 1% mark until the end of 2021, which actually also makes sense, as little bit inflation is also good for economy and lower interest rates tend to cause this inflation to increase. So let's understand how it all works. Well, lower interest rates will attract consumers to borrow more, which results in more money with consumers to spend, which at the end causes the economy to grow and inflation to rise. During the current situation, where consumer spending has taken a fall dramatically, such macroeconomical measures are the tools which central bank uses to control inflation. Second factor is minimum counter-cyclical capital buffer. You must be wondering, what is this term? Well, as per the European Systemic Board, the counter-cyclical capital buffer is one of the many macroprudential instruments under which banks accumulate capital when cyclical systemic risk is just to be increasing. And this buffer increases the resilience of the banking sector during periods of stress like current pandemic situation or 2008 real estate market crash. So in simple words, banks save money when economy is doing great so that during bad times it can use it to maintain liquidity and support economy. Primary objective of this counter-cyclical capital buffer is to use this capital to achieve the goal of protecting the banking sector from periods of excess aggregate credit growth, which we have seen in 2008 real estate market crash. This money banks have to hold and they cannot lend it or invest it. So as you can see in the current pandemic situation, German government decided to reduce this capital buffer to 0%. It means banks now have even more money available that they can lend or invest, which will further contribute in lowering the mortgage interest rates and hence supporting the real estate market growth further. So the counter-cyclical buffer is currently 0% till December 2020, but I think it will be extended till December 2021. Third and last factor is the three key ECB interest rates: deposit facility rate, rate of main refinancing operations or MRO rate, rate on the marginal lending facility. Well, let's understand each of these terms individually and then we will see how they influence the mortgage interest rates. So the first rate is deposit facility rate. It means the interest banks receive for depositing money with central bank overnight. And this rate is currently minus 0.5, which means if banks deposit their money in ECB, they have to pay ECB money. Next is the MRO rate, which defines the cost at which banks can borrow from central bank for a period of 1 week. And this rate is 0 currently. So banks can borrow money for free. And lastly, rate on marginal lending facility. It is the rate at which banks can borrow money from ECB overnight and this is also historically lowest and is 0.25. So you can see banks have no benefit to deposit money in ECB and they can borrow money for free. So it is like more beneficial for them to invest or lend this money instead to just keep it with them. So this all in turn reduces the interest rate at which end consumers like us can borrow money and further boost the economy. Well, the three factors we discussed suggest that mortgage interest rates will continue to remain low at least till 2021. So now we know the reasons why the mortgage interest rate will remain low, but let's see what can trigger the increase in mortgage interest rates. Well, once the corona crisis is over, the lowering of the counter-cyclical capital buffer to 0% needs to be reversed gradually. I personally think it will stay so till 2021, but no one can say for sure. So the option to avail mortgage is easier when capital buffer is 0% as more cash is available to banks to lend. However, when banks have to increase this counter-cyclical buffer, then either the mortgage interest rates will rise or loans won't be available. In both cases, it could affect real estate markets growth negatively. Well, please note here we are discussing each factor individually. However, weigh in all the factors before you reach to a conclusion. So at the end, anyone who is in a rush to buy a house now as the mortgage interest rates are low, don't worry, probability of them staying low for at least 1 to 2 years is really high. So take your time, do your research and then invest. Now let's check the second factor that affects the real estate market, which is the population growth. Germany's population is growing, but it's growing at a really slow rate. Not only that, the increase in population is all because of people migrating to Germany. So if you see this data, in 2019, the Statistical Bureau estimated around 770,000 people were born in Germany, while roughly 930,000 died, which in reality means it's a decreasing population. So if the population has to increase, it means people are migrating to Germany and contributing to the rise. Based on the numerical assessments, net arrivals from abroad are approximately 384,000. But unfortunately, this figure is in decline for the fourth consecutive year. And if this continues, then the population between the age group of 25 and 54 will decrease by approximately 1.5 million every decade. And you can see this in this graph also. In 2020, 32.5 million people were in this age group, and it reduced by 1.6 million to 30.9 by 2030. And it will continue to reduce to 29.4 by 2040 and will finally end up 28 million by 2050. Decreasing young population is never good for a country, and it's definitely not good for real estate. But the good news is that this number alone does not mean anything. Yes, overall population of Germany is decreasing, but what if the population of 7 major cities is still increasing? Then decrease in overall population won't have a big impact on real estate in these major cities. And in reality, this is also the case. Not only this, Germany is not a homeowner market from international point of view. Germany occupies the second to last place with a home ownership ratio of about 51%, which is well below the EU average of 69%. So as we have seen, the increase in population is contributed by the increase in immigration. Thus, the probability that migrants who are coming to Germany would like to own a house is higher than a German, which means further increase in real estate demand. People are not only migrating to Germany, most of them are migrating to the major metropolitans, and people within Germany are also moving to these cities for better job opportunities. Around 270,000 jobs were created nationwide in 2019, taking the total number of employed persons in Germany to 45.4 million. Well, most of them were office jobs and 1/3 are contributed by these 7 major cities. So as the number of jobs are created, companies will look for people to fill those jobs. Hence, more people will move to these major A cities, which at the end will increase the pressure on residential real estate. Another interesting thing to note here is if 270,000 jobs are created, it does not mean that only 270,000 people will move to Germany. It means 270,000 families will move or relocate to that place sooner or later. So to conclude, I would say if German industry keeps innovating and creating jobs, which they are doing right now, then the decrease in overall population at least won't impact the real estate market in major A cities of Germany. However, it might have a negative effect on the real estate market of smaller cities. As smaller cities have low paying to no jobs and their population is decreasing, it's a really bad sign for anyone who is thinking to invest in rural areas of Germany. Well, chances of real estate market growth rate going negative in Germany are really low. However, I think it will definitely reduce from its 5% average of last decade in short term. Also, one cannot say how the number of foreigners migrating to Germany will change in future. Again, depends on job opportunities and foreign policies. But if this number increases, it's a good news for all the real estate investors. However, if this number decreases, then it's a major concern. At the end, invest in or around big metropolitans and avoid investing in rural areas of Germany. So in this second part, we will discuss 3 factors that influence housing market. First factor that affects the real estate growth is construction of new houses. New construction is further dependent on labor and bureaucratic processes, which in turn is weighing down the new construction of houses in Germany. The lack of land zoned for construction, which is particularly problematic in urban centers, remains a primary obstacle to the construction of new units. Laborious planning and approval processes are also hampering construction, a factor made even worse because of low staff at building authorities. The number of civil service positions at building authorities has declined by around 10% since 2011. Even many investors have complained about the lengthy procedures in building authorities. Well, this doesn't end here. Once a building project has overcome this obstacle, the shortage of skilled workers at construction companies are the next hurdles to completing the construction of new residential unit. According to figures published by D-Status, although the number of employees in the construction industry increased by 30% between 2009 and 2019, the order backlog, however, tripled in the same period. And the current pandemic situation has made it even worse, as skilled workers from abroad are unable to enter the country now. So, slow construction activities are unable to match up with the real estate demand, which at the end increases pressure on real estate market and triggers the price rise. Not only this, the construction industry is building more single family houses but fewer multi-family houses, and is therefore failing to meet the overall needs of the rental market. Well, this is the situation in general. However, if we check it based on big urban cities and rural cities, it is completely different. In rural areas, too many new single family houses were built, which have a dampening effect on further rent rises and price growth rates in medium term. However, despite a general increase in construction activities, there is a marked undersupply with increasing demand in urban areas. Hence, in urban areas, both prices and rents are likely to rise even further in the coming years. So to conclude, in short to medium term, we may see positive growth in real estate market, especially in the large cities due to high demand and low supply. However, in longer term, the population of Germany is shrinking and growing older, and the number of new households is predicted to increase, especially to 2035. This mismatch does not look favorable for German real estate market. Well, the overall population is decreasing. However, there is large regional differences. So an intelligent real estate investor would be better off investing in and around big cities than in rural regions of Germany. Also check part 1 to learn more about Germany's shrinking population. Well, let's dive into the second factor that contributes to the real estate market growth or decline. This factor is the rent that you can receive from your property. As an investor looking for positive cash flow, rental income is very important. If the average rent that you can get is low and the price of the house is high, then it's not a favorable rental yield. In Germany, we have seen increase in house prices and rents recently. However, this increase in rents in major metropolitans have become a pressing issue, and government has already made many policies to counter it. One of them is the rental cap, that is the maximum rent one can charge. You might have also heard this term. It is called Mietpreisbremse in German. It is possible government will further tighten the policies related to rent, which could slow down the price growth we are seeing right now. Well, either investors will find a way around these policies, or it will lead to decrease or a halt to real estate price. So we discussed the perspective of a landlord. Let's check a tenant's perspective. If rental prices increases beyond a point and mortgage interest rates remain low, then many tenants will find that it would be equally affordable to pay off a loan and may decide to buy their own home. So it's both positive and negative for real estate market. On one hand, there is an increased demand. On the other hand, real estate market is less attractive to buy to rent investors because of low number of potential tenants. So to conclude, with time, without government interference, market will automatically come to a rent and house price that complements each other. However, if government interferes and affects the rent negatively, it can have a negative impact on real estate market in general and can end the real estate cycle sooner than expected. As per this survey, housing is the second most important issue for Germans after climate change. But it was pre-pandemic survey, and currently all the focus is on resolving the current situation and helping the economy to recover. But once economy comes back to normal, hopefully by 2022, housing will be a topic that no one can ignore. Therefore, it is likely that we will see some new political reforms in this direction in the short term. However, whether the result of these actions will be favorable to investors or not, only time will tell. Next factor that affects the real estate market is lack of macroprudential measures by the government. One thing that Deutsche Bank's report asserts the most is the lack of macroprudential measures by the government. The effect of lack of these measures is government trying to regulate the real estate market to control the real estate and rental price growth, however ending up with the opposite results, that is pushing the prices even higher. Deutsche Bank provided several factors and examples to support their case in their report. Well, let's check them one by one. First factor that they mentioned is the lack or no clear communication to investors about the fundamental value of German residential and commercial real estate. As per their report, we would need a solid and reliable assessment of the fundamental value of a property. For residential properties, Deutsche Bank believe a comparison of German cities with other European cities, and on top of it, corrections for competitiveness, income levels, quality of life, and other factors could be a way to assess the fundamental value of a property. Well, based on a simple model such as this, ranges could be defined for under and over valuations of the fundamental value, with extreme ranges being defined as bubbles. Using this model as a basis, regulators would be able to communicate, well, at least roughly, which measures will be taken when the fundamental value is exceeded by a certain margin. As neither investors nor regulators know the fundamental of a real estate, they cannot take appropriate measures or judge whether a housing unit is overvalued or not. So presently, many people may say real estate is overvalued or it's a bubble. However, there are no concrete parameters on which one can say that. I personally think when buying a house is not possible for an average person, then market has entered the high valuation territory. However, if average person still have means to own a house and pay back the mortgage, it is safe to say that housing markets still have some room to grow. However, please note, none of it means that the market will crash or keep growing. It is just one of the means to check the depth of the water. Next factor is the creation of random policies by the government and hoping to have a collective positive effect. Some of such policies are special accelerated depreciation allowances, reduction of construction costs, the new law on incentives to build housing for rental, Baukindergeld, etc. All these policies raise real estate prices and rents, even though this is exactly what the regulators wanted to control. I will also post the link of these websites in the description so that you can read it in detail. And if you want me to cover how Baukindergeld works in my videos, let me know in the comments down below. Well, there is also a fundamental problem with the macroprudential measures. These measures are not having a targeted effect, as no distinction is being made between new buildings and existing properties, as well as between the number of housing units required in urban areas versus rural areas. Therefore, overly loose regulations only constrain real estate prices and rents to a marginal extent. On the other hand, these same regulations constrained the new construction activity, which ended up in continued shortage of housing units. At the end, regulators do not have sufficient information to regulate the housing market in a targeted manner. So overall, regulations are being introduced here and there in the hope that they will have the desired effect at some point in time. However, an overall concept is lacking in both the political world and the real estate industry. If a concept were in place, one would be able to make a detailed analysis now of how many residential units are required for which tenant segments, in which towns, and under which demand trend assumptions. So to conclude, the gap between demand and supply is going to stay there for at least 5 years, and with supply of households being lower than the demand, both real estate prices and rents will continue to rise, especially in urban areas. Also, I think German real estate market was undervalued for a long time, and yes, the prices have increased drastically the last decade, but I do not think German real estate market is a bubble yet. However, the risk of housing bubble is increasing. This is the last part of the real estate analysis series. First factor that we are going to discuss is change in working mode and how it may affect the housing market. The corona crisis raises the question of how the increase in the number of people working from home will affect the residential and office real estate market. As per many analysts, work from home seems to be a temporary solution, and companies and employees will go back to old ways once the crisis is history. However, it would be interesting to see how work from home shapes our society. If we see that work from home will be the next hip culture, then it will not only affect the office space negatively, but also the residential real estate. People would prefer to move back to their hometowns or cheaper places. It will relieve the pressure on housing space in big cities and hence may end the real estate cycle. With recent announcements on permanent work from home by some big names, it looks like the temporary situation may become permanent, and other companies may follow the suit sooner or later. However, it seems unlikely to happen in Germany. Although work from home offers its benefits like reduce the number of commuters and help reach carbon emission targets, but there are also arguments against it. Many workplaces cannot be fully transferred to an employee's home due to legal and regulatory requirements. A number of employee surveys reveal that working from home can have a negative effect on employee health. In particular, workers miss the clear separation between work and free time. What will happen in the future, no one can say. However, I think there is a good probability of increase in permanent work from home, which may slow down the real estate growth in big cities. However, opening opportunities in other areas like logistics and data centers because of drastic increase in e-commerce and data consumption. I will also talk about promising investment opportunities in data center REITs in my coming videos. So if you think that would be something interesting for you, subscribe to the channel so that you do not miss the video. Another trend that we can see is increasing living floor space per capita. Higher income and asset levels and the trend towards one-person households has contributed to the rise in living floor space per capita over the past few years. According to D-Status, living floor space per capita rose from 42.5 square meter in 2009 to almost 47 square meter in 2018. The total number of households increased by 3% between 2008 and 2018, while one-person households were up by 6%. According to the D-Status Household Projection 2020, the number of one-person households will rise by some 3% by 2025 and around 5% by 2030. Well, by this data, we can deduce two things. First, increase in demand for one-person household will somewhat compensate the shrinking population, and second is that investing in one or two rooms apartment or households is more attractive and will see more growth in future. I personally prefer to invest in one or two room apartment if I am giving it to a single person, and 3 rooms apartment if I am making it a shared apartment or WG in German. So before I move to conclusion, I would also like to share some history lessons with you. If we check the history, prices usually fall all the more sharply the longer it takes for the negative developments to affect the market. Let's take Iceland, UK, Netherlands, Denmark, Spain and Greece as example. In this graph, we can see that real estate price in all the countries saw similar price falls of roughly 10 to 15% for the first 3 years of the cycle. So if you see, the cycle lasted 5, 6 and 10 years in Iceland, UK and Netherlands respectively. On the other hand, real estate market of Greece and Spain hasn't recovered yet. Historically, Germany has a solid track record of successfully overcoming many other economic crises. Therefore, considering a well-managed crisis with swift recovery is more likely than a deep and long-term downturn with gradual recovery. If we see how well Germany handled the COVID situation as compared to other countries, I think Germany will recover swiftly if any real estate crash happens in future. So there are many uncertainties down the road. However, considering the factors above, I think real estate market growth may slow down in short term. Next is how economy recovers once the pandemic is over. That will decide in which direction real estate market will move. So as a long-term investor myself, if I find a good property, I will invest and will keep investing in the downturn also if we see any. As in the worst case scenario, if real estate market crashes, which I think it will not, at least not in Germany, I think it will take at most 10 years for prices to recover to their former peaks in nominal terms, that is real value plus inflation. And during that recovery time, I am still getting my rent. So overall, my portfolio would have performed way better if I would have invested, as you can see here also. At last, I will consider following things before picking a property. I would prefer to invest in 1 or 2 room apartments. I would invest in order to rent the property. I would invest in regions near or around major cities of Germany. As one can clearly see here, the residential real estate price increase in big cities with larger population was way higher than cities with less population. I will also consider my job situation, and finally, I will not invest all my money. For anyone interested in reading the reports, I will post the links in the description. So what do you think? Do you think investing in real estate now is a good idea or not? Also, if you think this video was helpful, please let me know in the comments or by liking this video, and don't forget to subscribe to my channel and share this video with your friends.